Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In today's video, I'm going to share with you three different companies that we've not actually spoken about for a long time. Some of these companies are they're not really well known companies. You've probably seen one or their two products, but they're not very well known, and they are growing their dividends absolutely amazingly, as well as of course their revenue and everything else. So what I would like to do is share that with you guys, show you what these companies basically do as well as their financials. And again, as always, if you're interested in more details, do your own research, inshallah, find out a bit more information. This is just for entertainment purposes. If you haven't joined us on the Patreon account, please do so. That really helps the channel. Like the video, subscribe to the channel, let me know if you have any questions. And the first company that we're going to talk about today is MSCI. This is one of the data analytics companies out there. They deal a lot of the indexes and so on. They do have the analytical segment. They have the indexes. So if you ever looked around for ETFs, you've probably seen the name in there. So that's the first company that we're going to look at today. And the first thing we're going to do is just look at their financials. Okay, as you can see here, they have 43.9 billion market cap. So it's a large company, and it has a 1.14 dividend yield, which is quite small, but again, the payout ratio is very low, 41%. Latest increase was 16% and 24% increase in the last 5 years, which is quite nice. The company actually reported recently their earnings. Okay, so they beat top line and bottom line, as well as organic operating revenue growth of almost 15%. Recurring subscriptions was almost 17%, which is absolutely amazing. And I love this about the company. This means basically other companies have subscription for this for their services, and every single year they pay that for that subscription, which is absolutely amazing. So new recurring subscription sales were up basically 1.2, which is not bad. Organic recurring subscription run rate growth rate of almost to 10%, and retention rate of 93.6%, which is absolutely amazing. So that means people are not actually leaving this company, they're not running away from the company. So I love that. I love that basically the fact the company is in a solid business. Okay, 9 years of increasing that dividend, you got $6.40 for every share of this company that you own. And right now it basically looks undervalued according to this. Okay, so the 5-year average basically is based on the dividend theory. Okay, so the 5-year average was less than 1%. Right now we're looking at about 1.1% dividend yield, which is quite nice. And when it comes to PE, the 40, and right now we're looking at about 38. So again, it basically seems cheaper than it was in the last 5 years. But when you look at the financials, the financial sector normally has loads of banks and so on, which have very low PE. So I don't even look at that normally. Now looking at the earnings payout ratio, normally below 60 is what we're looking for. Right now it's 43%. Almost 40% for free cash flow payout ratio, which is nice. Earnings per share is wonderfully growing. So from 2014, last 10 years, look at this. Okay, 2014 to right now, basically from $2 to right now 14.7, which is absolutely huge. Free cash flow per share from $2.20 to right now $16.40. Amazing, absolutely wonderful to see that. Shares outstanding is declining, so they're buying back their own shares, which is quite nice. And total sales is going up, so the total revenue from $1 billion to right now $2.5 billion in the last 10 years as well. Return on equity, right now they have a negative return on equity, so minus 131. Return on invested capital 35%, and operating margins of 55%. Free cash flow margin of 46%, which is quite nice. Net debt to EBITDA right now we're looking at below 3 is what we're looking for. Right now is 2.45, so it is actually declining, which is quite nice to see. Now in terms of valuations, let's go back here, a couple of more things. We need to look at earnings estimates for the next few years. So you're looking about almost 10%, 15%, again 13%, 10%, and so on in terms of EPS. And in terms of revenue estimates, we're looking about 12%, 10%, 10% again, 6%, and so on, which is quite nice. So more or less double digits every single year growth side of things. Now in the next 5 years, according to Yahoo Finance, okay, so next year they're expecting about 14%, and then every single year 13%. So it's growing really nicely in terms of basically that. Now looking at Morningstar, it's 2-star stock right now, which means it is expensive. So it's 16% premium. So this is one that I would definitely consider going forward, but I will add it just to my watch list and leave it there. It has a wide economic moat, great company. $460 per share is where the Morningstar thinks. I can't really agree with that. But when we go back here and you look at the ratings from Seeking Alpha, you can see it is a buy right now. And as you can see, it's almost 9% upside from where we are right now. So on Wall Street, analyst is exactly based 2 buys and 2 holds. Not Wall Street, Seeking Alpha. And Quants is actually saying is a hold. So it's one, if we see a if we see a correction in the market, and it can happen easily, and if that happens, it's something that I will definitely look into adding to the portfolio and consider it for the long run. Of course, I'll do a little bit more research and so on. But looking at the moving forward in the next whatever years, if it comes down again, I will definitely consider. Right, let's now compare it with the S&P 500. I'm just looking for the performance. I want to see the total return for this company for 3 years. As you can see, almost the same. So 30 is beating the market for the last 3 years. Last 5 years, 231. And the S&P 500 is actually only returned about 80%. And the last 10 years, 1,306. This one is returned 167. So it's done absolutely amazing. Again, the past does not tell us what's going to happen in the future, but again, it seems a very high quality business. So one that I will definitely be adding to my watch list and leave it there for now and see if we get a correction. I'll probably start buying it a little bit here and there, inshallah. But of course, I'm going to do a little bit more research. Just before I move on, as you can see here, in terms of free cash flow as well, it looks like it's growing ahead in the right direction. If you haven't liked the video yet, please do that because it definitely helps the channel. Now, looking at Old Dominion Freight Line, which is a company that I've come across a while ago, but I've actually never done basically deep, looked into it in detail. And the company operates as a less than truckload motor carrier in the United States and North America, and provides a lot of these things basically for in that region. Now, look at their financial is $46 billion market cap. So it's actually a large cap company. 0.48 dividend yield right now, 13% payout ratio, and 30% growth recently. So in January of 24, they've actually increased 24. They've increased it 30%, which is absolutely huge. And the last 5 years, 36%, absolutely amazing. There's not that many companies that are doing that. Only 6 years of increasing that dividend, and $2.08 is what you get for every share of this company that you own. It seems undervalued at the moment because the 5-year average is 0.4 and 0.48 is where it's at right now. In terms of PE though, it seems a bit expensive. So 29.3 right now, 33.5. So it seems a little bit expensive, and it's more expensive than the industrial sector. Of course, payout ratio, we're looking for below 60. Right now, it's about 16%. Free cash flow payout ratio as well, 23% instead of 60, which is nice. Earnings per share is growing. Free cash flow per share is actually heading in the right direction. Looking at shares outstanding is declining, and total sales has been going up, but just this year it's kind of basically more or less the same from 2023 into 2024, more or less the same. Return on equity right now 31%, and return on invested capital, we're looking at about 38%, which is absolutely huge. Operating margin of 28% and free cash flow margin of 10%. And then when it comes to net debt to EBITDA, right now is non-existent. So this company has basically is doing absolutely amazing in that side of things. Now, in terms of growth side of it, okay, current next year they're expecting the earnings to grow about 15%, then 10% every single year. If we go back here and check what that looks like on the estimate side of it every single year, so 14, 16, 8%, and then almost 9% to 11%, then 8%, 9%, 11%, which is absolutely huge. Okay, so for this type of business, now looking at their valuation side of things, if we go to first, Morningstar is actually just 1 star, means it's expensive right now, 44%. Again, that's another one that you could potentially add to your watch list and see if there is a pullback in the market. Right now, price is 424, 433 today, and basically just below 300 is what they think the price should be right now. So it has a narrow economic moat. And one more thing, while we're still here, I want to show you in the trailing basically 10 years, 28%. So this company has had total returns in the last 10 years of 28% per year, which is absolutely huge. Now, looking at the ratings here, as you can see, Quant is actually saying is a hold, Seeking Alpha analyst is a hold, Wall Street is a buy. Let's have a look at how many. So we've got 8 strong buys, 1 buy and 10 hold and 3 sales, and that is about 5% flat from where we are now, downside from where we are. Now comparing this with the S&P 500, let's just see the total return in the last couple of years. So as you can see, last 3 years, when this decides to load up, okay, so 102% in comparison to 28% in the last 3 years, which is absolutely crazy. Last 5 years, this company has returned 334%, and the S&P 500 is about 80%, sorry, 1,100 something and 167, which is absolutely ridiculous. So these 2 companies that we've seen so far have beaten the markets in the last 10 years massively. And final company we're going to look at today is called Pool Corporation. This company has a very simple business model, unlike the first one here. We've got distributes swimming pool supplies, equipment, and related leisure products in the United States and internationally. As simple as that. Okay. The company currently, let's see, for year to date, it's actually down about 5%. So let's have a look at the financials. So the company has 15.1 billion market cap. So it's a large cap, 1.16 in terms of dividend yield right now. Only 31% in terms of payout ratio, 10% growth in last year, 22% in the last basically 5 years, which is absolutely huge. 12 years of increasing that dividends. $4.40 is what you will get for every share of this company that you own. It seems undervalued as well. Again, $1.106. That's basically the 5-year average. 1.16 is where it is at right now. In terms of forward PE, we're looking at the 5-year average of 29.4. Right now it's 27.4. So again, that tells us it's actually slightly cheaper. The consumer discretionary side of things is basically looking about 15. Right now it's about 27 in PE for this company. Now in terms of earnings payout ratio, it's about 32%, which is nice, and 34% in terms of free cash flow payout ratio. Earnings per share is increasing, but it's just stopped. Basically last year we had a little bit of decline, but it's kind of bouncing back again. Free cash flow per share is also heading in the right direction. If we look at shares outstanding, you can see it's declining, which is really nice. So the company is buying back their own shares. They're also giving you some dividends. Total sales in the last basically 10 years has actually gone from $2 to right now $5.63. Return on equity, we're looking at about 42%. Return on invested capital of 28%. Operating margins of 14% and free cash flow margin of 16%, which is quite nice. Net debt to EBITDA right now 1.34. Below 3 is what we're normally looking for. Now looking at the earnings estimates for the next couple of years, as you can see, 28% decline in 2023. So they have to report, I think they have reported their final quarter, and then after that 6% and then 12% bounce back after that. And then same goes for their revenue. So they have a little bit of decline, but they will be basically back in terms of that. Now, if we look at the Yahoo Finance, okay, as you can see here, next year, so about 6% and then 8% decline from there onwards. Now, it's very, very expensive as well. Again, at 19% up premium right now. $326 per share is where they think the price should be. The company has a wide economic moat. And then if we look at the trailing 12 months, basically the total return in the last 10 years, we're looking at about 21%, which is absolutely huge. One more thing I'm going to show you, because for the first one, we actually didn't see their trailing returns, which is 29%, almost 30%. Now, if you go back to Yahoo Seeking Alpha, one thing I want to look at is the Wall Street expectations, what they think. So about 2% upside from where we are right now. And if we compare this with the S&P 500, let's see if this one also beats the market. Let's see if we can get a hat trick out of these companies. Right, so the last 3 years when this decides 27 and 28. So we lost by just about 1% in the last 3 years. Almost a flat, but 156 in the last 5 years, and then being against the 79, and the last 10 years 640 6 against 167, which is absolutely huge. So all three companies have beaten the market in the last 5 to 10 years, which is absolutely huge. And this is not companies that everyone talks about. They are growing their dividend. They're doing really well in terms of dividend side of things. They're doing well in terms of price appreciation, as well as, of course, beating the markets, which is quite nice. So I really like this. I really genuinely like these companies. And if we put them side by side, as you can see here, so Paul 156% return in the last 5 years. We've already seen that the S&P 5, and all of them beat them. The 3 years, as you can see, these two are very close, but the rest of them actually done really well. And the last 5-10 years, basically, you can see it there. So absolutely great companies, in my opinion. Okay, it's ones that I will definitely be paying close eye to, especially MSCI. That one seems really interesting. So I will be adding those companies to my watch list and see if the market pull back. And then, of course, then I will be looking at into, inshallah, maybe into buying just a small bit here and there, and then, of course, build a good position on these companies. Now, again, as always, this is just for entertainment purposes. If you're interested in any of the companies that we talked about today, of course, do your own research. Please don't just rely on just what we just talked about today. And of course, if you can, please, it really genuinely helps the channel. So if you can join us the Patreon account, that would be absolutely wonderful. And like the video, subscribe to the channel. Let me know if you have any questions. Have a wonderful day. Assalamu Alaikum.